There are few differences here. First of all, the lending-borrowing relationship in Islamic home finance doesn't exist. So there is no existence for the element of interest. The other thing is the underlying Sharia compliant principles, which is the diminishing musharaka or the co-ownership agreement and the lease agreement, the ijara agreement. So that's the structure of the home finance product, which might not be clear to many people. For them, they will see the ultimate outcome is similar to traditional mortgage. But if they look into the structure itself, they will find it completely different structure, and the home finance product works completely in different way. The other element is, under the diminishing musharaka agreement, both the bank and the customer are partners in this property. So both of them are responsible for the property and responsible for each other. This element is absent in the traditional mortgage. Basically, the bank will lend the money to the customer and charge them interest for that money and take a legal charge over the property. That's the end of the relationship. So whatever happens to the property is the responsibility of the customer. However, in the case of home finance, as the bank is a partner in the property, the bank also responsible for the property, and the bank holds the legal title of the property. So the bank in this case will be more looking into the well-being of the customer, and this will give more assurances to the customer as the bank taking some risk and basically sharing the risk with the customers in this property. So it's joint venture for them. It is pretty much, if I can give a quick example, let's say two brothers. One has the money, the other one doesn't have the money, and he wants to buy a taxi to work on it because he doesn't have a job. So the brother who has the money offered to pay a proportion of the price of the taxi. Let's say he offered to pay 15,000, the other brother has 5,000 in savings. And both of them basically own the taxi. However, brother one who offered the money is not interested in the taxi. He just wanted to help his brother to buy the taxi and find a job. But for his money, he wants a return. So he agreed with his brother to pay him a monthly rent for his share of the taxi. And over time, when his brother has the money, he can pay back the money and he will own the taxi outright. So it's pretty much similar agreement that we can do on individual basis among others, among each other. In this case, the bank will provide the finance to the customer, and the customer will contribute to buy the property, and together will be partners until the customer purchases the bank's share in the property and owns the property outright at the end of the finance term. The other aspect is, or maybe the main difference between Islamic and conventional finance, conventional mortgage, if you want to sell the property at any time or pay off the finance amount, they will charge you or they will penalize you, because basically they will lose on that because you are paying off your mortgage. However, in Islamic banks, they are not allowed to charge the customer if they want to redeem or settle the finance early, because it's not a lending-borrowing relationship here. It's a joint partnership between the bank and the customer. And if the customer wants to exit this agreement, so they are free to exit this agreement without any penalties imposed by the bank.